Welcome to The Explainer. Today, we're jumping straight in and taking a really deep dive into the real hidden dynamics behind global energy panics. Look, right now, the world kind of thinks it's watching a massive traditional oil crisis unfold. Energy markets are completely all over the place, and you've got governments across Europe and Asia just scrambling to hold these emergency meetings. It's exactly the kind of panic that makes you worry about the price of everything, from your next tank of gas right down to the smartphone in your pocket. And on the surface, well, the panic makes perfect sense. But to really understand what's actually going on, we have to look past the breaking headlines. We're going to uncover this incredibly fascinating story about geopolitical positioning, hidden leverage, and how the global economy has fundamentally changed its shape. Everything traces back to a narrow strip of water providing the only sea passage from the Persian Gulf to the open ocean. I'm talking about the Strait of Hormuz. 20%. Just let that number sink in for a second. Every single day, roughly 20% of the world's daily oil passes right through this exact spot. It is, without a doubt, literally the single most important geographic choke point on the entire planet. Okay, let's dive into this. Because that one simple question is exactly what triggers global panic. The general consensus out there is pretty clear. If something goes wrong in the street, if this massive daily flow of energy suddenly just stops, the global economy gets turned completely upside down. But as we start digging into the data, you kind of realize maybe that's just the story we've all been conditioned to believe. The truth is, oil shocks do not hit the world equally. They never have. While some economies get absolutely crushed by a disruption, others quietly benefit. Section 1, the outdated oil narrative, looking at this through a 20-year-old lens. To really understand who actually benefits, we first need to look at why that general consensus is so wrong. We're basically viewing this potential crisis through a lens from 2 decades ago. 20 years ago, the United States was insanely dependent on foreign oil. Roughly 60% of its total petroleum consumption came directly from imports. Back then, if there was a disruption in the Middle East, the U.S. economy practically hit a brick wall. Prices spiked, inflation surged, everything just hit pause. It was a very clear linear relationship. But today, thanks to the U.S. shale boom, the script has completely flipped. The United States isn't just less dependent, it has literally become the largest oil producer in the world. So that old narrative is entirely outdated. The United States is simply no longer on the losing side of this trade. So that brings us to Section 2, an asymmetric energy shock. Who is really exposed? If the United States isn't the primary victim of a disruption in the Middle East anymore, we need to figure out who actually takes the hit. Now, what's really interesting about this slide is exactly where all that oil is actually going. A tiny, tiny fraction, just 2.5%, is heading to the United States. The vast majority of the oil moving through the Strait of Hormuz is heading straight to Asia. Specifically, we're talking about China, India, Japan, and South Korea. Together, those 4 countries account for roughly 75% of it. So when people say a disruption will shock the global economy, I mean, they aren't wrong, but they're entirely missing the fact that this is a highly asymmetric shock. Here is the absolute core difference in how this shock is felt. For the United States, a disruption is primarily a price problem. Because oil is priced globally, tighter supply makes prices go up everywhere. Sure, it hurts the consumer at the pump, but broadly speaking, it's generally manageable. But for Asia, it becomes a devastating supply problem. They aren't just paying more, they are physically losing access to the energy they desperately need to run their countries. And when that happens, energy gets rationed, factories stall out, and production just grinds to a halt. It's the exact same geopolitical event, but with completely different structural consequences. Because of this dynamic, when supply tightens and prices rise, it actually creates clear winners and losers. And right now, structurally speaking, the United States sits firmly on the winning side. Think about it. Higher global oil prices generate massive revenue for American energy producers, exporters, and companies. It's a slightly bizarre reality to wrap your head around. The exact same geopolitical shock that creates intense economic pain in stalled factories in Asia actually injects massive revenue right into the U.S. economy. Let's move on to Section 3, the hidden natural gas layer. This is the overlooked market. You see, oil is really only half the story here. To truly grasp the stakes, we need to peel back the next layer and look at another critical energy market that most people are completely overlooking right now. The Middle East isn't just about oil. It's also one of the largest exporters of liquefied natural gas, or LNG, in the entire world. Roughly 20% of the global supply of LNG passes right through the Strait of Hormuz. On top of that, massive producers like Qatar and the UAE send over 90% of their LNG exports through this exact same geographic choke point. If the strait gets blocked, global gas markets tighten immediately right alongside oil. And this brilliantly illustrates a fascinating twist of history sort of repeating itself. Over the past decade, the United States quietly built itself up to become the largest exporter of liquefied natural gas in the world. So that dynamic we just saw with oil, it happens all over again with gas. When regions in Asia or Europe lose their critical LNG supply from the Middle East, the United States is perfectly positioned to step in, sell, and benefit. Market scarcity suddenly creates tremendous geopolitical and economic opportunity.
Section 4. The Geopolitical Chess Match. This is where we get into strategic leverage.
This brings us out of pure energy economics and directly into the realm of global strategy. We know who benefits, but we need to focus squarely on who suffers the most from these disruptions. And the biggest loser in this scenario? It's China. Their daily oil dependency is staggering. China's the largest importer of oil on the planet. They consume an enormous 15 to 16 million barrels every single day. But here's the critical vulnerability. Roughly 11 million of those barrels have to be imported. This is a severe structural energy deficit, and a huge portion of those imports flows directly from the Middle East, right through the Strait of Hormuz. Now, China is acutely aware of this vulnerability. They haven't just been sitting around waiting for a crisis to hit. They've spent years actively building defensive safeguards. Think of it kind of like a squirrel frantically hoarding nuts for an impending endless winter. They are diversifying their suppliers, relentlessly building up their strategic petroleum reserves, and expanding imports from nations like Russia, Brazil, and Venezuela. They've aggressively tried to hedge their bets. But the reality of their massive consumption means these safeguards have really only delayed the risk, not eliminated it. Because of all those preparations, China can absolutely handle a short disruption. They treat it as a short-term inconvenience. They just absorb the shock and draw down on those massive reserves. But if the disruption lasts long enough, it mutates into a long-term structural problem. China's core economy, its entire manufacturing base, and its export power all fundamentally depend on a continuous, uninterrupted flow of energy. If those reserves run low and the physical flow of oil and gas stops, the underlying structure of their economy faces an overwhelming amount of pressure. Let's move to and see how this builds into the bigger underlying picture. Because the timing of all this global panic is remarkably fascinating. Tensions in the Middle East and around the Strait of Hormuz are escalating at the exact same time that the economic relationship between the world's two largest economies is steadily unraveling. Whether it's tariffs, technology restrictions, or supply chain decoupling, the US and China are in a really complex phase of economic realignment right now. It all boils down to a pretty simple truth about global strategy. In international geopolitics, negotiations are rarely just about finding a friendly mutual solution. They are fundamentally about leverage. And leverage is born directly from pressure, economic pressure, market pressure, and energy pressure. When one nation possesses the domestic resources to tolerate a global energy shock, while its primary geopolitical rival faces severe structural collapse from that very same shock, well, the crisis itself transforms. It stops being just a story about energy and actually becomes a powerful tool of strategic leverage. Which leaves us with this final, profound question. When we look at all these shifting dynamics of global oil and gas, the rise of U.S. energy independence, and the glaring structural vulnerabilities of manufacturing giants in Asia, is the Strait of Hormuz really just a choke point for oil? Or has it quietly become the ultimate choke point for global power? It completely changes how you view the daily headlines, doesn't it? Thank you so much for joining me for this explainer, and I really hope this deeper look leaves you with a clearer understanding of the hidden mechanics driving our world today. Keep questioning the narrative, and I'll see you next time.